while being slightly fast-paced. The American Depositary Receipt for Taiwan Semiconductor Manufacturing Co. Limited, TSM, is currently trading at 299.88, reflecting a decline of $4.64 or 1.52% in today's intraday trading session as of October 10, 2025. This downward movement might seem like a simple profit-taking dip after the stock's recent spectacular run, but the deeper reality is that this slight pullback masks a far more significant shift in the company's revenue mix, a shift that makes TSM less reliant on the volatile consumer electronics cycle and increasingly the single indispensable gateway to the global artificial intelligence boom. While the general investment community sees TSM as the world's most critical contract chipmaker, the unexpected twist is that its future is being forged not by its largest client, Apple stock, but by the unrelenting, insatiable demand from NVIDIA stock and other AI hardware innovators, whose orders are reshaping TSM's capital expenditure strategy and guaranteeing pricing power for its most advanced nodes. This is a critical distinction that fundamentally alters the risk profile, pushing past the traditional geopolitical concerns that tend to dominate the headlines surrounding this essential tech titan. For anyone engaging in online investing or looking for investment help to diversify their individual brokerage through platforms like Fidelity or Interactive Brokers, understanding this subtle but seismic change is paramount to accurately valuing TSM today. The daily price action for TSM saw the stock open today at 302.31, slightly below its previous close of 304.52, and it has since traded within a range of 397.42 to 302.83. This tight, downward channel is characteristic of a market digesting major news, specifically the company's stellar September revenue report released just yesterday. That report announced consolidated revenue for September 2025 that was approximately NT 330.98 billion, representing a 31.4% increase year-over-year. Now, here's the hook that defies initial expectations. Traditionally, such a massive revenue surge, especially one that culminates in a third-quarter revenue beat of about $32.5 billion, should have propelled the stock to a new intraday high above its recent peak of 307.30. Instead, we see a retreat. Why the disconnect between phenomenal financial performance and a soft stock price? The answer lies in the technical landscape and the psychological overhang of the company's valuation. The stock has rallied over 21% in the past month alone, fueled by anticipation of these very results and the broader semiconductors momentum. This short-term profit-taking is a healthy, albeit frustrating, reaction to a stock that has become hot money. For active investors using tools like Robinhood stock trading or the SoFi Invest platform, this is the moment to distinguish between short-term noise and long-term signal. The signal is that the year-to-date revenue growth is a colossal 36.4%, a figure that absolutely confirms TSM's indispensable role in the current tech cycle. This remarkable growth trajectory is being overwhelmingly driven by its high-performance computing, HPC, which includes AI chips, essentially making the company the toll collector on the AI superhighway. The narrative is no longer about a cyclical chipmaker, it's about a foundational, secular growth engine. Looking at institutional activity over the most recent reported quarter, Q2 2025, the picture is one of complex institutional rebalancing. We saw over 1,500 institutional holders increase their positions, adding more than 67 million shares, yet almost 1,000 decreased their positions, shedding over 73 million shares. This divergence, particularly the significant reductions by large players like Infinitum Asset Management and Goldman Sachs, suggests a risk-off trade at that time due to the high geopolitical premium and possibly overextended valuation. However, companies like FMR LLC substantially increased their position, demonstrating a deep conviction in the long-term AI-driven narrative. This institutional churn highlights the tension between the stock's immense strategic importance and the inherent geopolitical risk that keeps even the sharpest minds at Fidelity Investments or monitoring their Schwab intelligence portfolios perpetually cautious. When you are looking to invest online and select your own positions in an individual brokerage account, you must weigh the confidence of those who increased their stake, seeing the future AI growth, against those who took profit, wary of macro risks. The recent September revenue print, which is arguably one of the most important metrics not tied to a quarterly earnings call, serves to validate the aggressive buyers and potentially make the cautious sellers regret their earlier timing. The market consensus remains overwhelmingly bullish, with nearly 95% of analysts maintaining a buy or equivalent rating. And recent price targets from firms like Barclays reaching as high as $330, indicating a belief that this recent price action is merely a momentary pause before the climb resumes. The fundamental business of Taiwan Semiconductor Manufacturing Co. Limited, TSMC, is so central to modern technology that its name is almost a misnomer. It is not simply a manufacturer, but the world's most advanced technology foundry. Its business model, the pure-play foundry, revolutionized the semiconductor industry by focusing solely on manufacturing chips for other fabless companies, allowing clients to pour all their resources into design. This structure makes TSM a beneficiary of every major technological advancement, from smartphones, historically dominated by Apple stock, to cloud computing, electric vehicles, a growing segment that even impacts Tesla stock's supply chain, and, most critically, artificial intelligence. TSM's proprietary fabrication processes, particularly the cutting-edge 3-nanometer and 3 and 5-nanometer and 5, are where the true moat lies. These advanced nodes accounted for 58% of total wafer sales in the second quarter of 2025, and their demand is what gives TSM unparalleled pricing power. They are the only ones who can manufacture the most complex AI accelerators designed by NVIDIA stock and AMD. In essence, TSM is the exclusive locksmith holding the master key to the next decade of digital innovation. Older reports consistently show that TSM maintains significantly higher gross margins than its competitors, a testament to its technological lead and high production yields. And this is why their capital expenditure plans are so enormous. They are constantly running to stay ahead, a race that no one else has proven they can consistently win. Their commitment to spending a planned $38 billion to $42 billion in capital expenditure for 2025 is a massive bet on continued demand, far eclipsing the spending of even major tech conglomerates. This kind of aggressive investment is often what separates market leaders from also-rans, reinforcing the company's formidable competitive advantage. The reaction to the third quarter results and recent news flow perfectly encapsulates the tension between expectation and reality. The market expected a good quarter because of the AI narrative, but the sheer velocity of the 31.4% year-over-year revenue surge provides the reality of a business accelerating far beyond mere recovery from the post-pandemic chip glut. The growth story is not just robust, it's an AI infrastructure-driven tsunami. Management's guidance for AI-related revenue to double in 2025 and grow at a 40% compound annual growth rate through 2030 is the powerful, underappreciated catalyst. Investors need to stop viewing TSM simply as a cyclical company tied to memory prices or phone sales. They should view TSM as an AI utility company, providing the essential, high-margin components for every other growth story. The shift in focus to the 2-nanometer N2, which is on track for mass production in the coming year, and the subsequent A16 node, showcases a clear technology roadmap that will cement its lead over rivals like Intel for years to come, a narrative that should comfort anyone who uses modern platforms to practice self-investing. The geopolitical risks, particularly the U.S.-China tensions and the company's base in Taiwan, remain the single largest cloud hanging over the TSM stock. These risks are real and cannot be ignored, even when engaging in online investing. However, the strategic countermove, the aggressive government-supported expansion into the US, Arizona, and Japan, is TSM's attempt to de-risk its supply chain. This diversification of operational footprint is purposefully costly, estimated to drag down gross margins by 2 to 3% annually in the short term, but this strategic redundancy is crucial for securing long-term contracts with the U.S. government and major U.S. tech firms. It's a classic corporate trade-off: sacrifice a tiny fraction of short-term margin for massive long-term business continuity insurance. This is a brilliant strategic maneuver that is often overlooked in quick market analyses. The company is actively mitigating the primary risk factor, which should ultimately reduce the geopolitical discount applied to the stock's valuation. This is the unexpected resilience that makes the current pullback a point of deep analysis rather than a signal for panic. For investors who are comfortable with the inherent volatility of the semiconductor space and the nuances of international holding structures, TSM presents a unique opportunity. Whether you manage your own money with Robinhood or rely on the structured advice found in intelligent portfolio offerings, this stock is a critical component of the future tech economy. The demand for advanced chips will only intensify as generative AI moves from the cloud to edge devices, requiring more